And we are back trying to figure out what's going on in these financial markets as we continue to have macroeconomic data on the back burner amid a U.S. government shutdown, with the markets nevertheless swinging with gusto. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here is take a look at what the price action in these markets has done over these recent days, and then try to figure out what is the likely path forward here in the days ahead as we try to figure out, first and foremost, what will be the catalyst du jour, because we increasingly are looking at a set of conditions here that is starting to challenge sort of perceptions of market relationships and challenge what might have been the sort of going narrative for 6 months from the sentiment extremes in early April through the beginning of this month. But at the same time, the way that the markets begin this week really leave one wondering which direction the evolution in these trends is going to go. So let's take a look at, first and foremost, how these markets performed last week. We can see here the stock market found its legs ultimately after quite the sell-off in the previous week. What's interesting about all this, of course, is it looks like a fairly modest rebound and a fairly modest sell-off, but that kind of obfuscates what actually occurred. And this is where things get especially interesting. Because if we consider what the chart here looks like, even just for the S&P 500 as a kind of stand-in, we can see here that there is a tremendous amount of violence on this chart. And it really stems from that violent performance that we saw in the Friday price action there, where ostensibly the main issue was a situation where we had the escalation of the U.S.-China, let's call it trade conflict, because whether it is a war at this point or it isn't is about as complicated of a question as one might think of. Because, of course, one of the main sort of issues here very quickly becomes, well, are we actually looking at a negotiation, or are we instead looking at some sort of a drifting further apart of the world's largest economies? And what does that mean? If we look at the perspective in gold, one might say, well, this is what devolution of the U.S.-China relationship looks like. Markets are seemingly sort of betting on a further coming apart of the world's biggest economies, and perhaps that's why we're seeing the response that we're seeing from gold. That's how you get this relentless march higher. You once again, looking at the performance here for gold last week, you again get a potent push higher, 5.3% gain. At least this time, it somewhat coincides with a pullback in yield, so at least a little bit more sensible here. The 2-year in 1.9%, the 10-year in 1.2%, and at least this time the dollar is a little bit softer, so at least the sort of ingredients for a gold rally make sense. They were much less sensible last week, where the dollar was rallying, but at least this time the yen is up a little bit, 0.8%. The euro is up a little bit, 0.5%. But looking at sort of what last week wrought ultimately, that's almost a bit of a misnomer. Because if we consider that rise in the euro and that rise in the yen, it is more a reflection of risk aversion, seemingly, than anything else, because the Aussie ended up lower against the dollar. So did the Canadian dollar. So did the Kiwi dollar. So these commodity currencies that are the most linked to stock performance, they ended up ultimately having a bad week. And risk off currencies like the euro, the yen, the Swiss franc, they did better. And so this is what sort of makes today's rally so interesting. You'll note here we're basically back at the high that we set before this big sell-off. We're almost there. We're a little bit closer on the NASDAQ. And we ultimately haven't gone anywhere. What's particularly interesting about this whole endeavor is that when you look at the way that markets have performed since the beginning of the sell-off, here is that top before we really get going on a sell-off on that Friday. Here's last week's kind of meandering sideways. And of course, we heard that maybe the reason for the markets being soggy is this kerfuffle we had in the regional banks once again with the troubles that were had at Western Alliance and Zions. And that's tempting as an explanation. But what we see is this came, and the Russell, the small cap index here, was actually outperforming until that story. We can see the Russell was then crushed down to kind of join its other index cousins here. But this is where the whole situation is so interesting. If this sell-off was ostensibly about escalation in the U.S.-China trade war, which was the kind of main narrative, and if it is in fact a trade war, and we are in fact seeing these economies go further apart, and it's not just a sharp-elbowed negotiation, which is sort of the assumption that the markets had until this latest escalation, then we're in a situation that's a little bit different. Because you can see here that what was underperforming through this whole period is the NASDAQ. It is narrowly now outperforming the S&P, but they're basically looking at the same thing. They've both essentially come back to flat. NASDAQ is down less than 0.1%. S&P is net down less than 0.2%. So we've rearranged this a little, but clearly, whatever is going on here, you'd think trade war escalation is primarily damaging, or at least disproportionately damaging, for small cap, cash poor companies versus cash rich tech mega names, which is what really populates the NASDAQ and what has been the driver of the stock rally going back close to 2 years at this point. So if that's the trade war, why is it concentrate? Why is the selling concentrated in NASDAQ here? And if it's the regional banks, well, how was the Russell outperforming here into that, and in fact is still outperforming? If those are the issues that we're concerned about. And so this, of course, lends one to ponder, well, what's actually going on here? And first of all, how did you end up with last week every attempt at undoing this sell-off running into a wall? And what was it today that seemingly broke that deadlock, at least to get out of this range, if not to get over the major high here? And there's a number of points that stick out. There was a deal on rare earths access between the U.S. and Australia that should get the U.S. access to almost all of what it needs within about a year's time. Then, of course, there were some positive comments from U.S. President Donald Trump about his upcoming meeting with Xi Jinping on the sidelines of the APEC conference in South Korea. That apparently is back on now, even in the parlance of the president, though he is saying that those 100% tariffs on China due for November the 1st are still on the menu unless there's a deal at this summit between he and Xi Jinping. We'll see what that might look like. And that's been sort of the story that people have told today, looking at the headlines, for how we are up. It's an interesting story because at the same time, we've had a rebound in gold, which has really been an avatar for how fractious this relationship is going to be. We've argued here that as you get escalation between the US and China, third countries have to ponder the possibility that there will be a US payments universe where the dollar continues to be the currency of settlement. Then maybe there will be another separate China-based universe where the yuan backed by gold will be the vehicle of settlement, and gold will be the sort of nonpartisan go-between if the two major powers here really go full Cold War and go into separate corners and establish for themselves separate financial ecosystems. Now, on a day like today, you get positive squawking from Washington, D.C. Stocks ostensibly rise around that idea, but gold is back within a hair of its record high, storming off the lows here. Also, by the way, not breaking its high, but at least consistency here. If we take a look at the way that these markets performed just today, you can see here's your wiggle higher in stocks. Yields are a little bit lower. Crude oil is leaking slightly. Dollar is back on the offensive. Euro and yen are both down this time. Bitcoin is back to doing its stocks on steroids thing. It is up when stocks are up, just more so because it's a more volatile asset. But gold is surging today, 3.8%. If this is in fact some kind of a thing where gold is a multipolarity hedge, as it were, then we have a situation here where the story seems to be inconsistent. And so you get pulled in the direction here of a conversation that instead says something along the lines of, rather than this being a story about this or that narrative, it seems more like a story about the markets resetting after last week's inconclusive price action before what is an eventful week at the very least on the earnings front. Before we get there, though, we may or may not get a U.S. CPI report this week. The expectation is that maybe we'll get one on Friday, finally, despite the government shutdown. Still no word on whether we're going to backfill this NFP report, but we are maybe going to get a CPI report on Friday. Going into it, relative standstill on policy expectations. We're sitting here with the October meeting fully baked for a rate cut, hugging the 100% mark here. And you can see that's unchanged from about a week ago. So no big controversy there. At least the possibility that it's a 50 basis point cut has vanished. It was there on Friday. It's clearly not here today. Looking at December, we're again hugging the high 90s here, right around 96% at this point, that we're going to get a second cut in December. Again, very little changed from a week ago. There's a slight possibility and a lower one than Friday that we'll have a 50 basis point cut, but that's in the low single digits. So we're very much anchored to this idea here, which of course still leaves the main disconnect between the markets and the Fed for 2026. where we can see here those two cuts that we just saw that the markets have already priced in, they're firmly in the Fed's summary of economic projections. No big surprise there. And we see that the markets know it, the Fed knows it, not really an object for speculative fervor there. But for next year, the Fed only sees one cut, the markets see 70 basis points in cuts. So they're erring on the side of 3. Now, we haven't had the kind of economic data that would help us to reconcile this disparity. But maybe finally we are going to get a view on inflation here. The core CPI number expected at 3.1%, which would be the highest since May 2024. We'll see if that actually transpires, or the headline rather, expected at the highest since May 2024. We'll see if that actually happens and if those numbers actually come out. But looking at the sort of upshot for where this conversation sits, here we are back at the highs here for the S&P, and one would think we would have been powering higher here more forcefully, considering going all the way back essentially to the beginning of sort of mid-May to early June. What we've seen is a very clear inverse relationship between Fed policy expectations becoming more dovish and stock markets going higher. That relationship appears to break right here at this most recent top for the markets. And so you have expectations going more dovish, but stocks, as of last week, were going down with those expectations. As of now, appear to be basically range bound. And so there's an interesting evolution here that seems to be occurring, whereby stocks are struggling to make hay of these expectations looking as dovish as they are. So we'll see what that looks like if we finally get some economic data to begin to reconcile what markets are looking at. Here's the US dollar, the other kind of big indicator in this story. And we can see that adding to this idea that, first and foremost, gold is not up because of some debasement narrative, because clearly that couldn't be happening if the dollar is trending higher, because after all, what is it that you're then debasing? And we can see that since the lows here, the dollar hasn't really set a weaker level since the beginning of July. And since the Fed meeting in mid-September, we have gone higher on the dollar. And that's despite policy expectations starting to look more dovish. And so the dollar here seemingly retaking its haven bid here, and maybe starting to anticipate something here. Because, again, since this Fed rate cut, we've only seen things get more dovish. You'd think the dollar would weaken on that basis, but it isn't, suggesting maybe it's once again finding a haven sort of appeal, perhaps alongside gold. We'll see what that looks like, but certainly if whatever is happening here in both gold and the dollar has to do with the Fed, it's not immediately obvious. As far as the data is concerned, it's a quiet calendar Monday through Thursday. We could get this existing home sales data if the government shutdown ends. Perhaps. We'll see. There's a little bit of inflation data on the menu for Canada and for the UK. We likewise just got Chinese GDP numbers overnight. Those were basically in line with expectations, 4.8%. Industrial production a little bit stronger than expected, 6.5% versus 5%. Retail sales basically spot on, 2.9% expected, 3% the actual result, and a come down from the prior month. No big shockers there. The really big story actually comes to us on Friday, where whether or not we get this CPI report, which we don't know I think, for sure, whether that's coming at this point. We are going to get a private sector look at the U.S. economy by way of these PMI numbers, and we can see that the expectations here is we're going to hold relatively steady on the manufacturing front, maybe even see a hold on growth or something close to it on the services side. Obviously, a cool down here from 54 down to 53, but maybe we get a situation where that isn't going to signal something more ominous. Obviously, the question of U.S. growth has been front and center for Fed officials here. And last week, we heard all sorts of dovish squawking on this front from everyone, of course, critically, including Governor Stephen Miran. But at this point, there is everything to figure out and not a whole lot of catalysts until this data is out. So we'll see how that is going to play from here. And if, in fact, we get some actual official data on top of it. The earnings calendar is, needless to say, long. A couple of the key names here, of course, the Magnificent Seven type of names, although there's clearly a lot here. But Netflix is up tomorrow. Tesla up on Wednesday. Those will be the big ones to watch here, it would seem, given how important these names are to the overall market cap. Thursday, in sort of adjacent names, you'll also get Intel, and obviously there's a ton of other reports around these. We'll see how that plays out. Perhaps the most interesting part of this story now is the latest numbers from FactSet, which we'll share in due course here tomorrow. We'll get an updated chart of this, but they are starting to show that the average for reporting of positive surprises for this earnings season actually gives us a net loss for the reporting companies of 0.1%, whereas the historical average is a 0.9% gain. And the average negative surprise is a 4.5% loss relative to a 2.6% historical decline. So we're having a hard time rallying on good news here around these earnings reports for the stock markets. We'll see what that means going forward. As far as positioning is concerned, I am begrudgingly still holding a little bit of a bearish exposure here going into the week, looking at the S&P and the NASDAQ, and still long the U.S. dollar, looking for it to continue to recover. So still short the Aussie, short the pound, short the euro, short the Canadian dollar. On the spot side, I'm also short the yen and the Swiss franc. And I've added a little bit of a Bitcoin short here through IBIT after last week's breakdown. We'll see if that manages to find legs. A little bit of a put vertical here. Here are those stock market shorts looking for the most recent highs to hold. They did today. We'll see if they continue to hold some put verticals here. Still long the bond market. That seems to be quietly working for now, and still short crude oil via a put spread here. That seems to be cautiously working as well. And that is Macro Money for today. As ever, we are here right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. I'm also now at u/Ilya Spivak on Reddit, so come check that out. That really is me. And I'm commenting on the Tasty Live subreddit there, so come check us out through that as well. In the meantime, happy trading. Macro Money's back tomorrow.